Okay, let's get started then. I think there's a few people who are joining on the stream as well as on the Zoom, but we can get started anyway. So, good afternoon, everyone. I'm delighted to welcome you to the Zambezi Capital Quarterly Market Update webinar. So, my name is Mao, and I'm on the investment team, and I'll be hosting this session alongside a few of my colleagues and an external guest as well. So, this webinar is being recorded. So, if you don't get a chance to stick around right up until the end, no worries, but we do encourage you to stay on as we'd like to hear some of the questions that the audience might have. So this webinar will actually provide you with an overview of the recent trends in the financial market and give you some insight into what's been happening both globally as well as in Zambia. But before we do get started, just a quick disclaimer. So I would like to clarify that this webinar is not intended to provide any financial advice, right? It's an opportunity for us to share our knowledge, our expertise, our opinion with you. So think of this webinar as more of an educational session. And we have a pretty diverse panel. So if there are things that you liked either clarified or explained a little bit more, feel free to drop a question in the chat and we'll be more than happy to address them time permitting. So we have a pretty packed session today. So we're going to be taking a look what's going on in the macroeconomic landscape, take a look at the financial markets, get an update on crypto, as well as tech and innovation, what's going on in the world of innovation and sustainability, and finally, overall investor sentiment. So our first speaker is Haggai, and he is the co-head of the investment team here at Zambezi Capital, and we'll be going over a global macroeconomic update. So over to you, Haggai.
Thank you so much, Mao, and good afternoon, everyone. Excited to be with you here for this webinar. I just want to provide you a quick snapshot of what we saw happened in the first quarter of 2023. And the bigger picture of the global economy is that we saw weak economic growth in the first quarter, driven by high inflationary environment and elevated interest rates. But labor markets, especially in advanced economies, remain healthy. What we've seen on the screen is what we try to visualize the growth of both developing and advanced economies through a heat map, which shows a purchasing managers index, basically captures the business output through, particularly in manufacturing sector and services. And the greener it gets, the more economic activities are improving. And what I've done in this kind of slide is just to break down what is happening and what we've seen both in advanced economies and in emerging economies, taking lens of three key macroeconomic indicators. One is the economic activity, which is being captured by GDP. And the second one is inflation. And the third one will be interest rates. My colleague will be dwelling a little bit more in detail because these are also impacting the financial markets. But to start with, in the economic activities perspective, what we saw as captured by GDP, especially in the developed economies, particularly the US, is that GDP slowed compared to previous quarters, but still maintained a positive momentum. GDP, particularly in the last quarter, increased by 1.1%, down from 2% in the fourth quarter. This acceleration in consumer spending, which was offset by businesses liquidating their inventories, was driven by weaker anticipation of demand later this year amid this high rise in borrowing costs and the signs of inflation and recession that we're hearing. Elsewhere in Europe, the 20-nation euro area expanded barely by 0.1% growth from previous quarter. And I think what we saw there was also a GDP expansion, but it was also very, very weak and slow. In developing economies and focus here in developing economies, particularly China, as you could see from the screen, China really expanded, particularly because of the end of these zero COVID policies, which helped revive an important source of demand within Asia. In fact, the GDP grew by 4.5% compared to the previous quarter in the 2022. One of the key drivers of the growth was the elimination of mobility restrictions that boosted production in the Chinese manufacturing sector and also helped bring back global supply operation back to pre-pandemic levels. And if we go to the next indicator, which is inflation, and inflation has been a key driver and major talk of within the economy, both in the financial markets, but also generally within the economy. What we're seeing, what we saw in the developed economies on the inflation side is that the inflation environment continues to be high. While it's still relatively high, we've seen a lot of cooling down happening in most economies, particularly the US and Europe. In fact, the US, the most reading that we got came in at 5%, down from the high levels of 9.1%, which was experienced in June, but still very far from the central bank's target of maintaining inflation within the target of 2%. I think perhaps the most puzzling thing that we saw is the continuous strength of the US economy labor market. Despite these restrictive monetary policies, the central bank, they are increasing interest rates and recession worries. Unemployment rate remains still very low at 3.5%. However, in developing countries, it's a different story, particularly in China. That's kind of the focus of the area. Is that much of the world is still grappling with runaway inflation stoked by energy prices and geopolitical events. In fact, China has the opposite. It has got a risk of deflation. Consumer prices rose only by 0.7% in March compared with a year earlier. While factory goods fell for the 6th month in a row, there is somewhere below people's Bank of China's price stability target, which is below the target of the central bank's policy rate. The last indicator I want to talk about is the rates. Generally, and I've mentioned a little bit of this area. Generally, what we've seen is that central banks have continued hiking their interest rates throughout, both in developing countries and advanced economies, but some are trying to hold their rates hike. The Federal Reserve, which is the central bank in the US, announced 2 rate hikes and recently increased by 25 basis points. Bank of England did the same, also hiked their interest rates 2 times, 50 basis point and 25 basis point, respectively, in their previous meetings. The European Central Bank remained more hawkish by comparison and only hiked interest twice. The only exception that we saw was Bank of Canada, the Bank of Japan, which made no further adjustment to its yield curve control policy, despite core inflation rising. Against this backdrop of weak economic growth, healthy labor market, especially in most advanced economies, and softening inflation, I think all eyes right now on the central bank to see what they would do, given that the economies are contracting, but inflation still remains high. And the recent statement that we got from the Federal Reserve signals that there are further Fed rate hikes, but the key variable for investors will be the impact of what's going on in the economy, particularly the banking turmoil. And as this happens, we urge investors to remain cautious because the reasons for safe investment still arise to ensure that the investments are safe. So that's all that we had on the global economy. I'll hand over back to Mao. And if there are any questions, I'm happy to take.
Thanks, Haggai. So to the audience, you actually see a recurring theme of inflation and interest rates in the next few presentations because that is a big issue over the last year. So it's a big problem, not just in Zambia, but worldwide as well. So our next speaker is actually an alumni from Financial Insight Zambia. So she will be talking to us about the macroeconomic landscape in Zambia. So thanks for joining us, Wupe. Take it away.
Thank you so much, Mao. Can you all hear me?
Yes.
Perfect. So I will be following from Haggai's presentation and basically giving a country-focused presentation. So particularly pertaining to the macroeconomic update and the Zambian landscape. So our first indicator is obviously a shocking PMI deterioration. PMI being the Purchasing Managers Index, which is a tracker of economic activity pulse. So we've been noted that it's dived below the 50-point mark. And if you go below 50, it means if you're in 50, it means you're not in a recession. So Zambia has basically dived below the 50-point mark. And this is mainly attributed to the exchange rate and slightly also alluded to the debt negotiations that have been going on in the country. And we've also experienced that we have economic growth despite the debt. According to Zamstats, the Zambian economy grew by 4.7% in 2022, which significantly beat many analysts' projections. And this was mainly because sectors such as education, transport, and storage were major drivers of growth, while the mining and agricultural sector, as always, had a large notable contribution to the GDP growth of the country. Another key topic of discussion has been the pace of the debt restructure and and the concerns that come with it. This is mainly coupled by the challenging global environment. As we all are aware, with what's happening in Ukraine, Russia, and the USA, obviously what goes on a global economy has a trickle down effect on the Zambian economy because we are third world country. Annual inflation also is back to double digits. And another key thing that was discussed is that it rose to a year-to-year date high of 9.9% recently. And the increase in inflation has mostly been attributed to the increase in both the food and non-food items. The prices of food and non-food items have really been increasing in the past couple of months, and that overall has had an effect on the annual rate of inflation in Zambia. On to the next slide. We've noted that there's improving liquidity, heightened maturities of government, and enhanced budgetary disbursements. And this is due to the fact that we've experienced a heightened inflow of maturities from the government, yes. And then we have mixed investor appetite for government securities, as there has been seen to be rebounding demand for treasury bills, while demand for bonds remained subdued. So overall, the yields of government securities have remained unchanged in the past couple of months. Another interesting point has been that there's been a second successive trade surplus recorded. So 2.8 billion was recorded in February 2023, and it's been moderated by a 13.8% decrease in exports, which went from 21 billion to 18 billion. And then imports were seen to have increased by 2.7% as they grew from 14.9 billion to 15.3 billion. Another point has been that the Kwacha recovers losses from the 2022 gains. And a very huge contributor or significant factor that has led to this is the increase in mining receipts and taxes. The increase in mining receipts and taxes have contributed to an influx of dollar receipts. So there's been a lot of forex coming into the Zambian economy. And obviously, we see that the central bank has continued to intervene as the mining and tax filing is an annual event, hence why we have observed an overall recovery of losses compared to 2022. So I was just giving a brief quarterly update on the Zambian economy. Over to you, Mal.
Awesome. Thanks, Wupe. Some really, really great local indicators to pay attention to over there. So thanks for that insight. Our next section is the financial market update. So I will be presenting on how the global markets, specifically the US, is performing. So building on Haggai and Wupe's presentation, so there are four key themes that we see going on in the US market. So the first being an economic slowdown. So not technically in a recession as of yet. However, the GDP for the first quarter of 2023 came in at around 1.1%, which is well below the expected 2% growth. And a big reason for this is, as Haggai actually mentioned, was we've seen an overall slowdown in business growth. So private inventory from businesses, this is business like spending on their inventory, was actually down for this quarter, which significantly impacted overall GDP. That being said, despite the fact that we still have persistently high inflation rates, which is most likely going to be a common theme throughout the year, consumer spending has actually increased on the quarter. And this was due to the US population spending more on things like cars, healthcare, hotels, restaurants. So a lot of post-pandemic purchases there. So this brings us to our next theme, which is monetary policy, so interest rates, right? So right now, the Federal Reserve, so whenever you hear Federal Reserve, just think of the central bank of the United States, so the Bank of Zambia equivalent of the United States. So the Fed right now is trying to strike a balance between controlling inflation and then maintaining economic growth, which is a really, really difficult thing to achieve. Because we've never really been in a situation like this where we've had really, high inflation and close to 0% interest rates. So right now they're doing everything they can to curb inflation, and the interest rates right now in the United States is sitting around 5.25% as of Wednesday, which might not seem like a big deal, but the jump from 0.25 to 5.25, that's about like a 20x jump, so 20 times jump. So imagine your costs going up by 20 times in less than a year. That's a really, really big deal. And so this goes on to our next theme of we're seeing regional banks actually starting to fail within the US. So with the most significant being Silicon Valley Bank, but then there's also been First Republic as well as Signature. And so what happened here is between 2020 and 2022, these like regional banks really, really increased their number of deposits. And in order to earn yield on those deposits, they stuck those into long-term mortgage-backed securities or treasury assets at low interest rates back in 2020, 2021. Now, as interest rates have actually been going higher, the value of those assets dropped just because there's an inverse relationship between those assets as well as like interest rates. So that created a hole in their balance sheet. And once the investors and like depositors got wind of this, they actually rushed to get their money out. That caused a bank run in less than 48 hours. So this is able to happen because now we have technology. We don't have to go and line up to get our money in the bank. We just get onto the website and just click a button and get our money there. So that has been happening. But despite this activity, the overall market index is up. So the S&P 500, which is the exchange traded fund that tracks the best 500 companies within the United States, was actually did see a gain this quarter, with significant gains coming more from the technology sector, more specifically semiconductors. So the chart that you're seeing here, the blue is the S&P 500, and then the orange is actually the technology sector. So the Nasdaq 100, which tracks the best 100 tech stocks. So part of the gains that came from the tech industry actually contributed to the overall market rise this quarter. So that is a brief overview of the global market update. So I'll just hand over the next section to Tafara, our head of compliance over at Zambezi Capital, and she'll be going over a precious metals market update. So over to you, Tafara.
Thank you so much for that introduction, Mal. Good afternoon, everyone in Zambia, and morning wherever everybody else is joining from. I'll be leading the precious market update here. So much like the S&P 500 or the NASDAQ, precious metals did perform the quarter higher. So we did see a lot of growth in the commodity sector, specifically precious metals, with gold seeing a 7.8% gain and silver seeing a 15.2% gain. So as we are in this investor climate where essentially we do have high inflation rates, and looking forward, we are expecting that the Fed will continue to fight inflation. And as investors become more aware of the consequences of the fiscal and monetary stimulus, investors are starting to look towards gold and silver as a hedge against inflation. So we are seeing a boom in that sector. So this just rings true a statement by JP Morgan, which is gold and silver are money and everything else is credit. And that's something investors are becoming more aware of. So when it comes to the economic factors that affect precious metals, they are basically two that contribute to that, and that's interest rates and inflation. So I just want to go in to paint that picture to give our listeners an understanding of how gold's price is affected by these current economic factors. So first, we'll dive into interest rates there. And essentially, when we look at interest rates, in this chart, you do see the federal funds rate being represented by the blue line. The gray areas are representing recessions. So this is looking back in history. And oftentimes with investments, you'll find that history doesn't always repeat itself, but oftentimes it does rhyme. So looking back, the Fed always usually will hike interest rates to conquer inflation. But then when we are in a recession, eventually the Fed will have to cut interest rates to stimulate the economy. So right now, as of May 3rd, the federal funds rate is 5.25%. And essentially right now, most economists are predicting a recession later on in the year. So when we now look forward to what that will do to the dollar specifically, so a high interest rates equals a stronger dollar. So I'm sure most of you have heard in most secular news that the dollar is strong relative to other currencies. So the dollar and gold do have an inverse correlation to each other. So a strong dollar means gold price goes down. And this is clearly shown in this chart here. And this chart basically shows that as gold goes higher, the dollar goes weaker and vice versa. So I do just want to point your attention there. In this chart, we do see that the gold price is represented by the orange line and the dollar is being represented by the blue line. So if I want you to draw your attention closer there to the 2008 financial crisis, the Fed then in that financial crisis did have to keep interest rates low to try stimulate the economy. And then gold did see some upside due to that decision. So I believe the 2008 financial crisis, gold soared from around $800 an ounce to over $1,900 per ounce in 2011. So that's 137% increase in price or portfolio income. So interest rates cuts will weaken the dollar, thus resulting in gold seeing more upside there. So now, because of this relationship, I want us to tie us back into where is gold now in this trajectory. So this is just a historical performance of gold from time there. So this chart goes as far back as to the 1915, the year 1915. And in this chart, gold is dotted by the blue line there. So we do see that gold generally does go, is heading upwards, not in a straight line, right? So we do have peaks and valleys up and down, but the general trend is upwards. And that's just because gold has been showing investors that it is a hedge against inflation. So essentially right now, gold has, in Q1, gold did have some upside, like I mentioned, and it has since then had some additional upside there. So right now it is trading above $2,000 an ounce, and it has been in a uptrend since November of last year. So this is just because more and more investors are deciding to include it in their portfolio. So because I'm a big financial advisor and I'm always an advocate for opportunities when I see them, instead of, I'll take the difficulty out of it, instead of, putting the pressure or the onus on you listeners to know what specific stocks to buy, you can just buy exchange traded funds. So ETFs are basically a basket of underlying assets or stocks that represent either a commodity or a type of company or a group of companies. So, and the ETF ticker symbols, which is how you identify the different ETFs. For gold, the first one is the GLD. So that's an ETF. And right now it's sitting at an 8.45% gain year to date. It will potentially see more upside provided we do get a recession later on in the year and more investors move towards including gold into their portfolios. Another way you can take advantage of the current economic climate is by shorting the dollar. And that you can do that on an ETF called UDN. That's the ticker symbol. And the dollar short right now is sitting at 2% year to date. So that may see some potential upside as well looking forward. And then silver may see some potential upside. Silver is more susceptible to recessionary pressures just because of its utility. So we do use silver practically. So it might be more affected by the recession if we do get one, whereas gold is seen as a hedge against inflation and it's seen as a wealth preservation tool. So that's why investors like to opt and have a preference for gold. But silver, you can use the ticker symbol SLV, and that has seen 3.95% growth there. So Mal, I hope after hearing this, you'll be incorporating gold in your portfolio.
I definitely will. And it is interesting to see that, even though there are negative things happening within the economy, there are still some opportunities to take advantage of these different movements in your portfolio. So thank you so much for the insight. And just like a reminder to the audience, if you do have any questions, feel free to drop them in the chat and we'll address them in our Q&A. So thanks to Farah. So the next section will actually be focused on tech, and I'll start off by giving an overview of what's happening in the crypto space. So when it comes to crypto, a lot of people just assume that it's all about price and money going up, but there are some fundamentals that go into it. So we'll be taking a look and breaking down the top two cryptocurrencies, digital assets, whatever you want to call them, which are Bitcoin and Ethereum. So starting with Bitcoin, when it comes to price, Bitcoin has actually been the best performing asset in Q1 2023. So it's had around a 74% gain, which has actually outpaced the NASDAQ index. And the reason why we're seeing this is, Bitcoin has this whole narrative of being a digital store of value. So when we talk of store of value, gold historically has been the physical store of value, and it's held that kind of like title for thousands of years. And when Bitcoin came along, it has this whole narrative of being the digital store of value. So we're seeing that whole narrative play out right now with all the banking failures going on. So that is impacting the price of Bitcoin. But if we take a look at the fundamentals, so we see the total network hash rate up by 34% on the quarter. So this just means, Bitcoin miners globally are still adding hash rate even in a bear market. So when I mention hash rate, this is just the combined computing power that is used to secure network and process transactions. So there's thousands of computers around the world that are all contributing to the Bitcoin network, and they're helping, actually process the transactions and secure the network. So right now it's currently sitting at around 370 exahash of energy, which makes Bitcoin the most secure computing network in the world. And then sitting on top of this powerful settlement layer is the Lightning Network, which facilitates micropayments to anyone in the world. And those payments settle instantly at a close to zero cost, right? So a fraction of a penny. That's how much it costs to send a payment over the Lightning Network. And so because we've seen adoption for Lightning payments continue to increase, mostly driven by applications integrating into the network. So, applications like Cash App and Venmo in the United States starting to integrate into the Lightning Network and offer that as part of its core products. And then finally, the big story here has actually been Bitcoin Ordinals, which is a new protocol that allows anyone to create NFTs on Bitcoin. So NFTs, for those of you who are new to the space, are non-fungible tokens, and these are just unique items, unique assets, unique identifiers that live on the blockchain, that hence the word non-fungible, right? So this is actually a really, really big deal because historically the technology or the code to build NFTs on the Bitcoin protocol did not exist before. But, in the last couple of years with the recent upgrade that happened, somebody actually figured it out. And there's been debates in the community whether NFTs are an appropriate use of Bitcoin block space. But I think it is good overall because the more NFTs that are created on Bitcoin, that means more demand for block space. More demand for block space equals more transaction fees paid. More transaction fees paid means more miners getting paid, and so if the miners are happy, they keep contributing to secure the network, which is overall good for the entire Bitcoin network. So that is Bitcoin in a nutshell. Now, switching over to Ethereum. Price-wise, ETH, the asset, also gained by about 43% in the quarter. So not as much as Bitcoin, but still a pretty decent amount. However, it did fail to claim the $2,000 mark and has faced some resistance at that level. Now, that being said, when we look at the metrics within Ethereum, we typically look at the decentralized finance space, so the DeFi space, and this has increased by about 65% on the quarter, and it's been driven by two factors really. So the first being a strong demand for liquid staking tokens, so things like staked ETH on Lido, and the other has actually been decentralized exchanges. So if you remember, last year we had a bloodbath, which with centralized exchanges, with FTX being the biggest failure. And so traders want to trade their digital assets without, the counterparty risk. So they've been moving their assets from centralized exchanges to decentralized exchanges, or DEXs, as we call them. And so the volumes for the DEXs have been going up, which has been contributing to the Ethereum DeFi activity, as well as pushing the price up. And then finally, with Ethereum, we had a really, really big major upgrade that happened on the network, and we're calling this the Shapella upgrade. So the Shapella upgrade just allowed validators to withdraw their staked ETH. So before, once people staked their Ether, it was locked in until this upgrade came up. So that was from around early 2021. So a lot of ETH was locked for the last 2 years, and this upgrade just allows people to actually withdraw their staked ETH as well as the rewards. So that should add some sell pressure to the Ethereum market, but it's overall good in terms of liquidity. So that is just a question. That is just an overview of what's happening in the crypto space. So our next presentation is going to be on technology and innovation. And so we have Carrie joining us, who is part of our operations team here at Zambezi Capital. And she's going to be talking to us about NFTs, again, non-fungible tokens, as well as AI, artificial intelligence. So over to you, Carrie.
Thank you so much, Mal. So for the technology and innovation update, we would basically be stepping into understanding how art has become digital gold, and basically trying to look at how search has become less about digging into thousands of articles and more about conversational and personalized content. NFTs, I think, just as Mal had put it, in the most basic form, is a digital ownership certificate that could represent something physical or digital. And so, looking at it from the standpoint of the African continent, there's been some really interesting use cases that have come out of the continent. But one of the biggest observations that has come out of these use cases is the very fact that they are more inclined towards luxury products. And you'll see why. So most recently, in South Africa, we've had an auction house called Stratus & Co. that's partnered with some of South Africa's top wine producers to offer Africa's first wine NFT. Now, as you know, vintage wine and its different ranges are more of a luxury commodity, which points back to how really the NFT use case on the continent is more inclined towards that. The other thing that we've also seen in Zambia is specific jewelry makers have begun to use non-fungible tokens as a form of authenticity that is tied to the physical jewelry. They are using cryptocurrencies to basically trade and then have the NFT as a form of certificate of authenticity that is tied to the physical piece of jewelry. In other use cases, what we've seen, or one of the most relevant and the biggest use case for the African continent has come out of art, where we've seen collaborations in Africa's biggest economies, such as South Africa and Nigeria, between different art companies and NFT platforms such as Super Rare, who are basically able to host different pieces of artworks, auction them, and then basically just tie these artwork to NFTs. Another really interesting use case, which in this instance sort of deviates from luxury products, but comes down to something that's more tangible and something that we see on a daily basis is property, fractional investments specifically in property. And so what we've seen on the continent coming out of some of Africa's biggest economies, such as South Africa, is companies such as Direct Property Token Africa that specialize in real estate investments, where they're utilizing NFTs as a digital token to represent ownership stake in certain income generating properties across Africa. Now, how this is also working in the fractional investment space is because home ownership has been a very big deal for a lot of African economies, some startups in Kenya and South Africa alike have ventured into using NFTs as a form of title to represent fractional ownership stake within housing properties. And so, although NFTs seem to have these amazing use cases, what we are now seeing in this market is the very fact that, as I've explained, NFTs are often tied to a physical asset. There is no legal framework that binds these two. And so essentially that disconnect has created a very slow adoption on the continent, where we are only projected to hit 800,000 users by 2027. And so governments need to begin to look at NFTs as a form of digital authentication that requires a legal framework to increase adoption. Next slide, please. Coming down to AI, from Bard to ChatGPT, a lot of us have tried these different AI search engines that seem to be really, really amusing, but they do present a couple of challenges. So AI search engines can provide personalized and conversational results, which has become very popular amongst many people. It's quick, it's easy, it's straight to the point. While it's a great way to enhance basically the user experience of anything, especially search, its tailored results essentially mean that keyword optimization is no longer the name of the game because it's not able to yield the desired results. And so basically what we see is that there's a bit of a blockade and a challenge when it comes down to marketing and how they now begin to ensure that they tailor their marketing campaigns and search engine optimization to be more conversational and personalized. So what we are now seeing is that close to 77% of people prefer AI search engines to traditional ones. And so basically brands have to come up against this challenge of how to really sort of navigate this entire space in terms of understanding the intent of users and the like. But another thing that's come up is basically this sort of compounds the challenge for digital marketing. And here's how. It compounds the challenge in the sense of it comes up against attribution. Now, attribution in marketing, digital marketing, would refer to any basic process that's assigning or giving credit to where specific campaigns or how to attribute specific campaigns to different marketing channels or touch points, right? So these different marketing channels or touch points are meant to essentially drive outcomes like conversions. But AI search engines essentially are converting data that's coming from different touch points and channels, right? And so because that's happening, AI search engines are essentially operating in a more broad ecosystem and interconnected channels. This means that sort of attributing where conversions come from. If I tell my ChatGPT, like, okay, so how much is Nike selling their sneakers for? It gives me a response based on all these different things. Nike is not able to attribute where that conversion of me buying sneakers essentially came from. And so because of that, AI has brought another layer to search, but it has also added an additional layer of complexity to marketing. So ensuring that content relevance and quality remains constant is going to be a very big challenge for this evolving AI-powered search. Thank you.
Thanks, Carrie. Those are really, really great insights. So a couple of things, when people think of NFTs, they usually get confused because it's usually, pictures of monkeys or something like that. But there are some actual use cases we could apply that technology in our physical world. And then, as you mentioned, I think it is interesting how AI is disrupting things like search. And it does pose the question of how traditional search engines like Google, who usually monetize through keywords and clicks, are going to survive this transformation. But I guess that's what disruption is all about. So moving on, we're actually going to get an impact and sustainability update from Daniel, who is part of the operations team here at Zambezi Capital. So over to you, Daniel.
Thanks, Mal. So in light of the impact and sustainability update, we've observed that green investing or impact investing in the financial market is becoming increasingly popular among investors, mostly those seeking to make positive impact. This rising interest in impact investing is being driven by maybe the desires of just addressing global issues such as climate change and social challenges. So if we look at the equity market side, the transportation sector, for example, is undergoing a transformation towards electric. For example, Tesla is leading the way in that aspect, and Tesla experienced substantial growth in a couple of years. But at the same time, we are seeing competition grow in the Chinese EV market as well. As you can see from the chart, interestingly, in 2020, we observed a surge in EV stocks, and these prices were driven by retail investor appetite, and this was short-lived, right? And in 2021, we saw a plummet of almost over 50%, and this, I think, can be reflected in the chart, as we can see from Tesla falling from, I think, a high of $400 to $100. But we believe that EV stocks have hit bottom, right? And we expect a recovery in the coming few quarters. Currently, Tesla has recovered about, I think, $68, right? $168 price per share from its low of $100 per share in January. Now, regarding the sustainable bonds or debt market, during quarter one, in the Saudi Arabia, under the Public Investment Fund, we saw that their issuance attracted over 32 billion in investor orders. This indicated strong demand and confidence for green bonds. India is also entering the market with its maiden sovereign green bonds rising about $1 billion just to invest in clean energy. So if we look at the next slide, so the sustainable bonds market has continued to thrive, and we've seen this through the data, right? And the green bonds reaching about $57 billion in January alone. This can sort of reflect how much we can sort of project to reach at the end of the year. According to Moody's, right, the credit rating agency, the sustainable bonds market overall is estimated to reach about $1 trillion in specific, 950 billion billion, not trillion, by the end of the year. Consisting of that is 550 billion in green bonds, 225 billion in social bonds, 175 billion in sustainability bonds, and 75 billion in SLBs, also known as sustainable linked bonds. So despite the inflationary concerns and geopolitics impacting various financial markets overall, including green and impact markets, there's a lot of opportunity that we see for impact-driven investment instruments for the capital and money markets overall. And through this growing demand among investors, as Zambezi Capital, our mission is to make impact investing the norm and our financial platform to serve as a beacon of trust in the digital economy. And through government support, e.g. the issuance of green bonds, policy initiatives just to combat climate change, address inequalities at the social side, promote sustainability, we believe we can achieve this. Zambia recently launched the Capital Markets Master Plan, and a great opportunity for us to tap into this sector and become a hub for green or impact investing on the continent. And the World Bank recently projected that the appetite for impact investing is about 26 trillion, and amounting of that we know that 10% of that is in global capital markets. And somewhat the highlights and the incredible potential of impact investing and the contributing of equitability and environmentally friendly future, and how much these investors are contributing to this development. We believe that green bonds and these different impact investment instruments are just beginning to emerge as well, and offering significant opportunities for these investors to also make positive impact in the African market and generating financial return as well. As we continue to address global issues such as climate change and social inequalities, and the vital role of these investors and governments to support and back in impact investment options, that's all that we had today in terms of how we look at impact and sustainability as Zambezi Capital. And I think this will present a huge opportunity for the whole country overall. And we're excited to sort of like dig deeper in this coming Q2 and just see how this whole development around impact and sustainability is developing. And that's it we had from the impact and sustainability update. Happy to take any questions regarding that. And back to you, Mal.
Awesome. Thanks, Daniel. And, I love how there's a whole trend in terms of demand for green bonds and impact investing expected to increase over the next few years, which is actually our mission over at Zambezi Capital. So thank you for that. And then now we're going to go over to our final presentation from Alina, who is part of our IR team over at Zambezi Capital, and she'll be giving us an investor sentiment update. So go ahead, Alina.
Thank you, Malanga. I have the honor to close us out. So my presentation is very short and sweet. Before I dive into this brief update, I would just like to recap what investor sentiment is. Investor sentiment refers to the overall attitude of investors towards a particular market or asset. And we can gauge investor sentiment by reviewing the trading activity and direction of prices within a particular market frame. For example, rising prices would indicate and point to positive investor sentiment. So the current perception we have as Zambezi Capital is that institutional investors have focused more on developed markets for near-term returns rather than diversification, which has then led to high levels of liquidity concentrated in the developed world, where global assets under management have grown by over 40% since 2015 and are expected to reach 145 trillion by 2025. From this data alone, we can dissect that in order to achieve returns, investors need to explore further new markets within Africa with a focus on native African economies. I think we can observe from trends that major investors into Africa tend to favor agriculture and mining. Recently, we've seen the Botswana renegotiating the terms of their long-standing diamond deal with De Beers to favor more native economy. And their current deal expires in June and will be interesting to witness how it plays out. Analysts and the president of Botswana himself have indicated that Botswana is in a very firm position to push for 50% of the stake, whereas currently Botswana is entitled to purchase up to 25% of the stones mined by De Beers, which, by the way, De Beers is considered to be the world's largest diamond supplier. And Botswana recently rose to the current 25% from a shoddy 10%. But moving on, despite having averaged 3.77% of growth over the past 2 decades and only contracting by 2% in 2020 due to COVID-19, native Africa has not received much like substantial investment. I'm going to move to the diagnosis now. The diagnosis is that success in African markets requires understanding of what our long-term trends are. Exploration and experimental approach is necessary within tactical market entry points and ground-level partnerships. Many investors still have these very outdated perceptions of what the African market looks like and feels like. Mutually reinforcing trends have restructured African economies and increased their resilience over the past 20 years. African growth has bounced back to 3.8% in 2021 after a contraction of 1.7% in 2020 due to the COVID-19 pandemic. As Zambezi Capital, our recommendation is that we believe investors must update their perception of risk in African markets as the continent becomes more resilient, digitized, and integrated through its trade relations with the East. To succeed, investors should focus more on understanding the market realities and finding the overlap between their internal requirements and what the current market needs are. They should also embrace flexibility and intersectional approaches. In this post-COVID-19 world, looking at African markets is no longer a niche option per se, but a mainstream necessity due to the geopolitical and economic dynamics. Thank you, Malanga.
Awesome. Thank you for that insight, Alina. Really, really great. So we've basically come to the end of our presentation. And, we'll be doing these on a quarterly basis. But if you'd like a little bit more, insight or more focused presentation on either, the economy or stocks or crypto, we'll be happy to do that too. Because over at Zambezi Capital, we're all passionate about financial literacy and financial education, which is actually going to be one of our big contribution towards the SEC's capital markets master plan. So we're just going to go into our Q&A session. Again, if you do have any questions, please type them into our chat. Otherwise, I will actually pull up some questions that I got earlier. So I'll actually start with Haggai. So, we're seeing the U.S. Federal Reserve, they just raised rates on Wednesday by about 25 basis points. So they're above that 5% level, which is the first time since 2007. And we're also seeing similar trends in rate hikes in other advanced economies. But what does this actually mean for developing economies in Africa, and particularly, what does it mean for Zambia?
Sure. Thanks, Maranga. I think what we're seeing is that what's going on in global economy generally has got impact both in developing countries, particularly in Zambia. There are two things that definitely comes to my mind. One is the effects generally on the global investment. As we see the rates rising in the United States, we see that safe American and corporate bonds start to look more attractive to global investors. And what that means is that there's a lot of capital flows in terms of investors putting their money from developing countries, or developing countries make their investment becomes less attractive, and then increasing more on corporate bonds and American bonds, American government bonds, which are fetching higher rates. And as a result, we see this as a key risk arise with increasing rates, particularly in developed countries. Linked to that is also, it just makes borrowing from the capital markets expensive. If you ask me right now, a 2-year treasury yield in the US is fetching around 3.89%. A 10-year is over 4%, just near 4%. And if you are borrowing from the capital markets, means that you can't borrow at a rate that is below that. You have to be borrowing at a rate that's higher than that. So borrowing from capital markets becomes more expensive, and as countries in the developing economies, particularly also firms as well, trying to access global capital markets, it becomes very expensive for them, especially firms trying to raise their debt and other kind of capital. The second part of it is from capital flows and just investment shifts. And I think this point Afara touched on it quite extensively in our presentation, is that as rates increases, it drives up the value of the dollar. So we're seeing strength in the dollar. And what that means is that other currencies now start to weaken, particularly those in developing countries, especially the way they are organized. Dollar is a major trading currency. And as it gets stronger, it has got effects on what other developing economies currencies will be. And this makes it very, very difficult, especially for countries who have got huge debt, which is largely dominated in the US dollar. And everything from debt repayment to imports becomes expensive. So at the end of the day, the countries in these developing economies, particularly Zambia, have got no option but to also find a way in which they can curb that. And the way they can do that is also to raise their policy rates. And that was recently we've seen what is happening with interest rates hiking. Central bank recently just hiked the interest rate here in Zambia. And so that also, they have to also control that to ensure that their currencies also become stronger. So at the end of the day, the impact will be felt to the developing countries through weakening economy. And I think it's something that our investors, both in developing countries, particularly in Zambia, have to look out for, monitor the situation that's going on. Thank you.
Awesome. Thanks for that. And just thinking about like interest rates, there's no way that they can continue to raise these interest rates without triggering a major recession. And once that does come around, they will have to drop it, and risk assets are going to go up. So this question is for Tafara. So you did mention that when these events happen, usually gold does actually go up. But in your opportunities slide, you did mention that there's like a gold ETF and a silver ETF. So the question that did come up is, what is the difference between both? Do I have to be looking at what the price of both is? Basically, what's the difference between both? And should I have exposure in one over the other, or should I just have like a mixed exposure?
Thank you, Mal, for that. So the difference between the two is the gold ETF is specifically includes gold miners, right? So these are the large cap gold miners, majors and miners. Whereas the silver is specifically, ETF is specifically contains companies that specialize in silver and silver mining, so producing and mining. So when it comes to your distribution, or your allocation, that just depends on what you're interested in. So if you're interested in hedging against inflation, gold is the route to go, right? Because gold has proved as a hedge against inflation historically. So if we do get a recession, I would suggest go the gold route. If you're looking for I guess more upside, so you're looking to gain more upside, that's why people tend to incorporate silver as well, because silver trades at a lower price. So if it does increase in value, you can get more growth, right? So I believe even for Q1, silver had seen 15.2% growth, whereas gold had seen 7.8% growth, right? So that's the kind of difference when it comes to the upside. But generally, gold performs better just because of that hedge against inflation. So there's more fund managers who look to incorporated hedge fund managers, institutional managers, sovereign funds as well, right? So are looking to incorporate gold into their portfolio.
Right.
If you analyze currently right now the outflows, who's buying gold on a sovereign scale, the Swiss are the largest buyers.
Nice.
And, right now, some of the emerging market countries are starting to participate in that market. So we are seeing China get more gold. And that's just due to the kind of geopolitical tensions. With the dollar being weaponized, I believe Haggai spoke about this, with the dollar being weaponized and the trend towards de-dollarization, people are turning to gold, right? So people are trying to incorporate more gold in their sovereign funds. So China is doing that. We're seeing Russia do that. We saw Russia do that actually before they went into the war with Ukraine, and UAE. So is also continuing to do that. Yeah. So that's the kind of difference.
Awesome. Okay, so basically, sorry about that. Basically, gold as an inflation hedge, and then silver more upside. But it is good to, based on your risk profile, to have both assets in your portfolio. Okay, that's really, really good. I'm definitely going to be incorporating that in my portfolio, but I do want to also incorporate some local investments in my portfolio. So the next question that comes up is for Daniel. So you did mention about green bonds and impact investing, but at least for me, I'd like to understand what's the difference between just the normal bonds that the government of the Bank of Zambia issues, or a central bank, versus green bonds. What's the difference between the two of them?
So the difference between the normal bonds and the green bonds is that green bonds are fixed income, of course, and they're financial instruments, but they're specifically designed to finance projects that have environmental benefit, right? But for the normal bonds, they don't have a restriction to specific sustainability, impact, or green projects. So that's the main difference. But otherwise, in terms of the structure or dynamics, in terms of how they operate, an investor apportions a certain amount and invests that for a certain period of time, and they get back interest, is the same fundamentals. But what's just different is we can actually see the positive impact, or we can measure the positive impact that it comes with in terms of like maybe issuance committing to a sustainable project or a green project, but the other doesn't have to measure the sustainable outcomes. That's the basic difference.
Got it. Okay, I totally understand. So the next question actually comes from Sean, and who is asking about what is the difference basically between globalization and geopolitics. So Elena isn't here anymore. She actually had to jump on for another call. She's actually going to be on TV. So I'll take this question. So basically, globalization refers to the interconnectedness of the world's economies, cultures, and societies. So for example, just looking at the flow of goods, services, capital, people across national boundaries. We're all just like in this huge melting pot of just like interconnectedness with regards to markets, communication technology. So once like if something affects like the US, we're probably going to just feel it all over the world. So that's like globalization. Geopolitics geopolitical things actually refers to the relationship between politics, power, and geography. So it really focuses on how natural resources, strategic locations actually impact political power. So we know like the United States right now is in power, but we're seeing all these tensions in Russia, as well as China trying to take over a little bit. So those are some major powers over there, and those geopolitical issues can affect like things like flow of trade, investments, technology, and the impact of the global economy. And then the next question that Sean also had is, and I think Tafara, maybe you can take this, on commodities. Would oil have a similar effect or impact on the markets similar to gold?
Yes. So the thing is, oil is a more, I guess, complex commodity in that there are different factors that also affect its price point. So one of the things that affects oil's price point is OPEC and their decision whether to decrease production or things like that. And then it depends on which region. So if you're trading, I guess, Brent oil in the US, it depends on what current, I guess, economic policies exist protecting the price of oil. So sometimes, for example, I believe last year, Joe Biden was using their reserve oil stores to ensure that the oil prices don't rise too much. OPEC did recently decide to cut production. So once they do decide to cut production, that will cause the price of oil to then go up. So there are a little bit more factors that can play into the price of oil. But yes, it is affected, but it's not necessarily seen as a hedge. Oil traditionally, right now, I guess what most people are kind of trying to determine is oil is priced in, as per Bretton Woods Agreement, is priced in US dollars. So, and you've heard people use the term the petrodollar. So ever since the dollar went off the gold standard, it was agreed that oil would be traded in dollars, US dollars. But now we are seeing oil being traded to China and Russia, and they are sometimes using the Chinese yuan. Sometimes they are using, there's kind of talk of like, what's the next currency? What's going to be the world's reserve currency? So oil is kind of might be one of the driving forces to determine which currency will gain that a reserve currency status or rise to compete against the dollar, oil will be, one of the commodities that, decides that or is the deciding factor. But when it comes to recessions, it does suffer just because of its utility, right? So if people are hard on cash, they don't do as much, which affects the demand, right? So that's kind of the pricing.
Yeah. No, thanks for the app. For sure, there's other factors, and this also goes back to the whole geopolitical factors because like certain countries can control the supply of oil, they do have like a really, really big impact on price. So OPEC is basically one of them, Saudi Arabia, and then also the United States. And it is very interesting to see that, ever since the dollar got off the gold standard, I think officially in 1972, the only reason, like the biggest reason I would say that it's remained as a reserve currency is because of the petrodollar, right? Because basically the OPEC has been selling oil in US dollar. That means everyone around the world who needs oil needs to purchase US dollars. So it's kind of like propped up the demand for US dollars. So it's going to be interesting to see what's going to happen when that gets dropped and then another currency actually takes over, right? Whether it's going to be whether it's going to be the Chinese currency or back to a gold standard, who knows? Or
even Bitcoin, who knows?
Even Bitcoin, yes, even Bitcoin, yeah. Yeah, it's going to be it's really, really going to be interesting. So I
even
have
Dogecoin.
Even what?
Dogecoin.
No.
No.
If Dogecoin becomes like the world currency, I will quit finance. Like
ask Elon Musk.
Yeah. Okay, if there's no other questions, I actually do have one more question. So I don't know, like just on the board, how involved you guys have been with like AI and artificial intelligence. I haven't gone like in depth into the technology as I would have liked to, just because I'm like busy with cryptocurrency and blockchain. But I have played around with a lot of tools. So I guess this question is for Carrie, if you're still on. So for me, I'm a big user of like ChatGPT. I've even paid for like the premium version. I use it for basically everything, work, school, you name it. But are there, like for you, Carrie, are there any other interesting AI tools that you've seen out there? Because I know you've mentioned a little bit about like AI search, like Bard or what's Microsoft's search, Bing, I guess. So yeah, that question is for you, Carrie, if you're still on.
Yeah. So I think for a very long time, AI was synonymous with automations, right? But what we've seen lately is now AI has taken over that space, in the sense that a couple of years ago, you had something called no code, where basically people like you and I who don't know how to code or who are not software engineers could build websites, right, through drag and drop. And so now AI has added an extra layer or a new use case that basically allows you to use prompts to build a website. So it's literally taken no code to the next level, in the sense that you have AI being able to facilitate for a lot of things, even outside of search, in terms of productivity tools and in terms of no code. And so essentially, that's the reason why I think you have a lot of people having the perspective that AI is basically out here to get all of us and is taking our jobs. I think it's moving very quickly. It does need some censorship, because even what we've seen lately is that you have a lot of these AI search engines that might not give the correct information. Some of these companies have also even admitted that, hey, we don't know what's going on with the algorithm on the back end, and that Bard or something else gave us a result that might be incorrect. So there's a lot of regulation and censorship that needs to happen in that space. So in spite of it being so great and giving us all this new utility, I think it's something that still needs to be coupled with the traditional essence of a lot of the digital tools we have existing today.
Yeah. And like you actually brought up a really, really good point where it's like, like it might give like the wrong answers. And for me, when I think of like like traditional search engines, like when I search something in Google, it brings up a list of like, different websites. And then I go through the websites and I kind of like decide, okay, this website is legit, this one is not. Whereas with AI, it'll just give you the answer. And then the question is like, okay, like where is it getting that answer from? Like how does it know that it's actually valid? What if like somebody is just like really, really good at like spitting out content that AI can read and that AI just actually just pick that? So I think that's a big, at least for me, that's like a really, really big confusion, but I still use it. I love the technology. It's like really great.
Yeah, and just to piggyback off what you said, Mal, I believe I read, just this is a practical example. I heard of a lot of hiring managers will, at
Mm,
large firms, will use AI to kind of sort through resumes to determine who to
mm,
hire. And they've kind of realized that they are excluding or further marginalizing minorities just because of their name or what's
yes.
specifically on their AI. So they're not getting access to those jobs because the hiring manager physically never gets the resume because the AI will take it out
Yeah.
automatically. So
Yeah.
they've done
Yeah.
studies where it's the same kind of credentials put on two different resumes, and maybe they'll change the gender, they'll change the name of the person, but the credentials are the same. And maybe the role is a traditionally masculine role, so it will only try pick men for that job. Or
Mm,
so there's a lot of, I guess, policy development that needs to take place on the ground to ensure that we are protecting marginalized communities and people who are at a disadvantage.
yes. Yes. I actually saw that study before, and it's very interesting because like artificial intelligence is just learning from us. So it like our biases just like gets like manifested and like basically just like time 10 times in AIs, and like it's just whatever, it just thinks that it's the right thing, right? So if traditionally like a white male has been hired for this role, it's typically going to look for that type of character, right? Whereas like we still need to teach it, like know about diversity, and like we need like all these other factors that come into play, not just like who might be the best for the role. um yeah,
I,
so
I, I was
we're
just going to
yeah,
add to that real quick. I think that
yeah.
a huge misconception with AI is that it works independently, but
Mm,
essentially learning off of what exists today. And so, just
yeah,
like
yeah.
Chafara had put, an initial barrier in the human resource space has always been the ATS. And then you compound the ATS application applicant tracking system with AI, essentially means if I say, for example, this is Google and they're looking for such and such a candidate, if
Mhm.
predominantly in that role only certain people apply or only certain people get there, that's what it takes. It doesn't take anything else out of that realm, and it would need to learn those things as time goes by.
Okay. Yes, yes. That is very true. There's actually a funny story. I forgot who released like an AI like a few years ago. They released like an AI Twitter account, which is just like AI and just like basically talking to people. And then like within a few days, it just became like super racist, super sexist, just because of like what the information it was getting from people, right? So we are like, yeah, you're right, Carrie. In fact, like it's not just like learning independently; it's just like getting information from the different people or different sources and different training data, and that's how it's learning. So we are still pretty early in that sense. Um, okay, so if we don't have any other questions or any other comments, I think we're good to end here. We are actually a little bit over. Well, at least we're coming up to the time that we had sent. So again, on behalf of Zambezi Capital, we do want to thank everyone who tuned in to listen. So we'll try to have these sessions every quarter, but like I mentioned, we are all about financial literacy and financial education. So if there is a particular topic that you'd like us to cover more in depth, or if you'd like more of a high level personal finance 101 or stocks 101 or crypto 101, we're very, very happy to do that. Again, we do want to thank you for your time over here. And once again, we are Zambezi Capital. And this is most of the team. Obviously, not everyone is here, but most of the speakers are a part of the executive team. So that's it from me. Daniel, I'm not sure if you wanted to give any closing remarks before we end.
Hey, so I think it was a great webinar, and being our first webinar, we expect to have many more of this, as Mal highlighted. But generally, all is well from my end in terms of just questions and clarities. But I'll urge audiences to this webinar to just send us questions, send us whatever how you'd want us to improve. And I think that's that then. Cheers.
Awesome. Awesome. Well, thank you, everyone, and enjoy the rest of your Saturday.